In this chapter, we study operating liabilities and contingencies. Let's start with operating liabilities. And first, let's review the definition of a liability. The conceptual framework defines liabilities as probable future sacrifices of economic benefits arising from present obligations to transfer assets or provide services in the future as a result of past transactions. Now, it's pretty wordy, that definition, and it comes from that conceptual framework that we studied in Intermediate Accounting 1. There's three major characteristics that you need to keep in mind here. The first is the word probable. The entity will probably need to make a future sacrifice. Second, there's little or no option to avoid the future sacrifice. And third, there's a transaction or event that has already taken place that has given rise to the obligation. Operating liabilities are obligations arising from the firm's primary business operations. They include short-term obligations such as accounts payable, trade notes payable, accrued liabilities such as advance collections, sales, payroll taxes, and income taxes. Let's start with accounts payable. They are amounts owed for goods, supplies, or services purchased on account. The invoice is the only formal documentation of the credit agreement. Trade notes payable are formal written promises to pay a certain sum of money on a specified date that arise from the purchase of goods, supplies, or services. So you can have trade accounts payable and trade notes payable. The main thing is that the trade description there is telling us that this is in the main primary part of the operations. Now, trade notes payable typically will have a stated rate of interest. So when we're doing our operating liabilities, we need to be able to accrue interest as necessary. Just so you know, firms usually classify accounts payable and trade notes payable as current liabilities because they're generally due within 1 year or the operating cycle. Let's take a look at an example. On May 5th, Ivan Brick Company orders 1,000 pallets of red bricks, and these are going to be on accounts payable. So we show I think it's FOB destination here. The bricks are received on May 12th. So on that date, the company takes title to it. They go ahead and record the inventory and show accounts payable. Okay, let's change it up a little bit. Instead, they're getting the inventory, but they're putting it on a 4-month note payable. And we have a 6% annual interest rate. So the fiscal year end is at December 31st. It's October 1st, the date that we received this. So October, November, December, 3 months will have occurred before year end date. So at year end, we're going to have to accrue the interest expense and show the interest payable. Now remember that when we do interest, it's principal times rate times time, and time is a fraction of the year. In this case, 3 months out of the 12 months. When it comes time to pay off the note payable, we're going to show the note payable going away for the full 10,000. We're going to show that interest payable going away for 150, and we're going to show the new interest expense that's been incurred from the beginning of the year till now.